Oh, hi, everybody. Well, welcome to our conversation today on bridge loans. So I'm Nikki James with Flagstar, and I'm delighted to be here today with Courtney. Go ahead and introduce yourselves. Just tell us hello, and let us know a little bit about your background, and we'll jump into some fun stuff on bridge lending.
Thanks, Nikki. I'm Courtney Jung, and this is Connor Lennon, and we work for City Real Estate in San Francisco. We focus mostly on San Francisco and the peninsula down to about Redwood City.
Yes, not only do we know Nikki on a professional level, but also have used one of her loan products for a purchase that we've made ourselves. So happy to give great testimonial on all the great info that she has for us today.
Thank you, and I have to say, you guys were about the best clients ever. So it's always helpful when you know a little bit more than some. But you guys were awesome, and I'm so thrilled that you were able to utilize this amazing financing. So what we're going to talk about is, how do I buy a house before selling? And the concern is with many people, I don't want to get out of the house I'm in. I don't want to have to give up maybe it's school districts or a certain commute until I know where I'm going. I don't want to get off the real estate ladder before I know where I can move into. And, in this market of, you guys can talk a little bit to the craziness of, Silicon Valley real estate, but it's not a guarantee that you can buy the house you want when you want. It's been a little, I don't even know, the last 5 years or even longer of just a bit of a very competitive market. So this product is an amazing tool to help you compete without selling first. So I'm going to go into some distinctions here about bridge lending. What is bridge lending? How do we do it? And then we'll have a chat with Connor and Courtney here as we go through and bring them in on some of the things that they found and questions that they had going on, and then also from their real estate expertise, how they can help you compete. So we're going to share my first slide here. Bridge loans. Bridge loans, what are they? There's three main structures to a bridge loan. And the main thing that we look at when we're looking at bridging is, what is your end income? How much money do you have for to qualify? How much do you have saved? What is the value of your current home? And any existing loans on the property. So we're looking at your current situation plus the new situation, and how much money do we have in the pot to put towards paying for the house, and then also towards the down payment. And some people have none. It's all the down payment is in their current home. That's what a bridge is. It helps us borrow the money that's in home equity to put towards the new purchase. So we have a screen here which we're going to share with you, which I don't know if it's going to come up here in a second, but I'll move on to looking at some of the numbers. So there we go. There we are. So I'm just going to go back. This is what I was just talking about. These are the 4 bullet points. There are the things that we look at: income, savings, current value of your home, and your existing property. And then there are 3 solutions to this, and they vary on cost and structure. So let's go through those 3 solutions. The first solution is the most simple. It's an equity line. If you happen to have an existing equity line on your home right now, we can use that towards the down payment on the new house. Now, when I say existing, that's a big key. You cannot go out and get a new equity line today and at the same time put an offer in on a property and say, can I use this equity line for the down payment on the new house? And the reason is because they're both owner-occupied loans. And you can't live in 2 houses at once, or at least you can't tell a lender you can live in 2 houses at once. So you can only use an equity line if you already have it. So one thing to know is, and Courtney and Connor, I'm sure you tell your clients this, it's always great to have an equity line. There's no downside to having an equity line. If you own a house, put an equity line on. It's just a great tool to have you be liquid in the future. So let's assume you didn't do that and you don't have an equity line. So then we look at doing a bridge loan. A bridge loan is like an equity line. It really is an equity line. It's above board. We know that you're not living in it. So it's a temporary loan, and that's why we call it a bridge. It's helping you get from here to there with your equity. We partner that with what we call a portfolio purchase loan, and that's because most people don't have the income to qualify for their current house, the bridge loan payment, the new house payment, and then the property and taxes and insurance on all of that. That's two properties that you qualify. Not many people we run into in the Bay Area can qualify. They have the income to support that. So this portfolio purchase loan allows us to say, well, hold on a second. You can't live in 2 houses at once. We just talked about that. So we're going to say that the house that you're leaving, you would rent out. And we offset the math. We just use the rental income that you could get on that house, and we offset the principal, interest, tax, and insurance payment on the old house with this magical rental income. We don't make you rent it out. We're not asking you to, but it's just purely a tricky way of underwriting that allows us to basically discount the house that you're leaving with payments so that we don't have to include those in your debt to income ratio. The third option is even more creative, and it's private. It's a private loan is a loan that's done by an individual, a group of individuals that I work with, who say, okay, the whole picture makes sense if you actually already own the house, but it doesn't make sense until you sell the other house. And so the reason that we use private financing is it doesn't make sense today, but it will make sense in the future. And so the equity is there, we'll give it to you. So that's not as common. Most people fall into bucket B, which of course is where Courtney and Connor, you fell. So we did that loan for you. So I'm gonna, do you guys, if you have any questions as either realtors or as, like as clients that you think people would ask Courtney, Connor, please do jump in here. All right, so I'm just going to show you some math so we can I did a lot of talking there, and it's sometimes hard to kind of understand it without seeing it in math. So let's just assume that we had a house that was worth $1.2 million today. We have an existing loan of $500,000, probably bought it 4 or 5 years ago. The math works out that we take 75% of $1.2 million minus what you owe, which is your 400,000, which is your 500,000, and we can give you a bridge loan of 400. So the magical number to remember is 75%. So whatever your house is currently worth, 75% of that we can use towards a bridge loan minus what you owe. Then we look at a new house. So let's just say we were going to buy a new house of 2.25. 20% down, which is doable on most purchases, would be a down payment requirement, giving you with the bridge loan of 400,000, you would need to come in with about 70. So you'd actually need to come in with 450 for the down payment, and then we put some closing costs in there. So you can see here how your cash to close is only 70 because you're getting 400 from the down payment, from the bridge loan. So hopefully that makes sense in terms of the math as to how you use the equity line, or the bridge loan as your equity to put the down payment down. From a qualification standpoint, if you look at this for a second, you've got your house with your current house with 500,000 plus a bridge loan plus a new loan of $1.8 million. That's a lot of debt. That's $2.7 million worth of debt that you would have to qualify for. And again, going back to what I said, not many people do. So that's why we use this product that allows me to offset the house that you're living with, potential rental income, offset the payment with a potential rental income. I know I explained this to you, Courtney and Connor, when we did the loan, and you've done it. I know it's complicated. When you went through it and you did the loan, what you saw was that you didn't have to put anything down, that you were able to bridge. Can you give us just a little bit about, in terms of your experience, in terms of closing, in terms of competing, what this enabled you to do?
Yeah, so I think, well, what's great about you, Nikki, is it only took you explaining it that one time on the phone to really get it, because the numbers, although they're a little bit abstract, when you explain it, I think it's pretty easy to understand. And what it helped us do was, one, it was a strategy. So what the cost of the bridge was surprisingly low from what we thought, because, first of all, you don't hear a lot about bridges these days. Not many lenders are doing them. They're very few and far between. And you always hear that they're extremely costly. In reality, this bridge only cost us about 25% of what the capital gains would have been on selling that same amount of stocks in order to come in with the down payment. So it was really actually very affordable to do it this way. And then also what we were really impressed with was that the terms were more or less the same. It was still a 30-day close, and it was still a non-contingent, fully underwritten offer. which also I think when you hear about bridges from the listing side, probably all of us have had bad experiences where they can take 45 days plus. And so we were expecting a longer escrow, and it wasn't that. It was more or less a regular escrow.
Yeah, that's super feedback, and you guys are expert at this, so you had a little bit of a leg up because you are an agent too, but understanding it as deep as you did as a client helped you then explain it to the selling agent, which again is part of the process, is making sure the selling agent understands it, because a lot of people run a mile. They say, oh my goodness, bridges are going to be expensive and they're going to take a long time to close. And you were able to explain that, as agents, you would be, when you represent your clients too, that don't penalize somebody because they don't want to sell their house first. As long as you're offering a great price to the seller, then this is a great way for us to get you in a financially smart way. And that's the other way of putting it to a seller and a listing agent, is that you're being savvy by doing this product because you didn't want to have the capital gains hit. Some people just don't have the cash, so they choose to do it because of that. But whichever reason it is, it's not a reason to penalize somebody as long as they're offering the price. And we do fully, as you mentioned, we do fully underwrite you ahead of time, so you can put in that non-contingent offer. You mentioned costs there, about how the bridge loan wasn't as costly. Let me go through that a little bit so we can explain how a bridge loan works. The interest rate's prime plus 3.5-ish. It depends on some of the qualifying. There's about a half of a point up front for the origination. So if it's a $400,000 loan, that's $2,000 up front. So not big in the big scheme of things. Again, as you were saying, compared to some potential other costs. One would be cap gains. The other would be, well, what's the cost of moving out, getting a rental, having my house staged, selling it, and then being able to compete and buy, moving out and all of that. I mean, between time and cost, it's amazing how that $2,000
well.
it's kind of meaningless pretty fast, doesn't it? Yeah. One huge piece here is there are no payments. So you guys haven't made any payments on your bridge loan because there are no payments. There are no payments until you pay off the house. Now, the interest rate accrues, of course. There is a cost to the loan, but we don't require you to make monthly payments. And that, from a cash flow perspective, is huge. There is no payments. So really important to know that if you're getting kind of worried about all the payments that you would have to be looking at. Going down to that portfolio loan that we pair it with, it's a great rate. It's a low 3s. Just know that, those obviously change, but obviously a 30-year fixed today, you're in the 2s, which is crazy, very low. So this loan's slightly higher, but it's not a lot higher. And basically the strategy is we put you into this portfolio loan and the bridge loan, and then after 6 months, we can then refinance you out. Once your house is sold, everything's settled, we can refinance you into a regular, good old steady Eddie, normal 30-year fixed loan. So that's that product. If anybody has any questions, obviously you can reach out to us directly and we can answer more. There's a lot of weeds to get into, and I'm not going to get into the weedy weeds today. But I am going to talk a little bit about the private loan, just to give you a high level. I was sharing with Courtney and Connor a recent client that I just am doing. They're selling a home in Mid-Peninsula in Menlo Park. It's about $4 million. And they're buying a $7 million home. So obviously huge numbers here, and we do this at all level numbers. So please don't get scared with the number of zeros there. But the point is that they, again, want to be able to compete. They have great income, great assets. They just can't hold 2 homes of that value at the same time. So they will be using a private loan because the numbers don't make sense until they're sold. The loan's costing them 2% up front of the loan amount. It's going to be a $5 million loan. They're putting in 2 of their own money. And then they can close in 2 weeks. This loan is much more flexible. The underwriting is much faster. We don't need an appraisal. So that, again, is how we use the private financing. It's all spectrums. I do it from lower purchase prices all the way up to the big guys. And again, it's a financially savvy product to enable you to compete. And that's the key. And maybe, guys, you can talk a little bit about that for us, in terms of competing. Can you talk about the advantages of having a bridge loan, the advantages of being able to buy before selling? How does that look in the marketplace?
Yeah, I think the advantages are clear, and anyone that's bought a home before, which most likely if they're interested in a bridge loan, they've bought before, they know that buying is difficult and selling is easy comparatively. So if we can purchase before selling, we can get the difficult part out of the way. And a lot of the reason that buying is difficult is because the market moves really, really quickly. And so if you can make that purchase while still being in the home that you're comfortable in, and get that difficult part out of the way first, you can most likely save yourself a lot of anxiety and stress, and probably save some money, because in those few months, most likely the market will continue to come up. You'll get new batches of comparable sales that'll come out. And so that home that you can purchase before selling, most likely you'll get it at a better price.
Mm-hmm. And also, I'm sure you can talk to the fact that if you don't live in the house and you've moved out completely, and you guys get to stage it and make it look beautiful and pretty, like none of us actually live.
It's a lot more convenient, certainly, for all parties involved, but definitely the seller / buyer, because, first of all, the buying can take, anywhere from 3 to 9 months. And so you don't want to go ahead and sell your home and get what you think will be a 1 to 2 month rental, and that ends up being, 9 months, can be very inconvenient. And this way, you know what you've bought, and that's probably taken the longer amount of time. Ideally, if your home is in the Bay Area, it probably should sell fast, especially if it is vacant and staged. So it's a much more smooth process of moving, I think.
Yeah, vacated and staged is the key to that, because it just is, we as consumers love to see how beautiful things look in the non-real world of, with all of the kids' stuff and the dogs out the way and all of that fun stuff.
That's right. And, potentially, yes, if you sell first, you know what you have in the pot, but there's nothing you can do to make that amount go up if the comps keep going up as you're trying to buy. But if you buy first, knowing that you'll be able to sell probably in just a short month or two, you can probably catch that same level of where the comps are. So I think it really is all around a strategy that financially ends up penciling out in the end.
It's so funny how many times I talk to people about the cost of a bridge loan, especially even in the private one, because that can cost $100,000 if you've got some big numbers there. That one that example that I use is actually, we worked out with the customer, is going to cost them about $200,000. But when you're selling a house, you talk in multiples of $100,000. Am I going to sell it for 2.1 or 2.2 or 2.3? You throw out these numbers like that, and you can get more top dollar. You as the agents can not promise, but that you're going to have a higher likelihood of getting top dollar if the house is pristine, clean, staged, move-in ready, versus somebody having to use their imagination as to, well, this could look like this if they didn't have that, and that. So there's the cost of the bridge or that type of financing gets kind of washed away fairly fast in most cases. Of course, none of us can promise, you do have a risk that you could hold 2 houses. We're not making a promise that it's going to sell fast, but you guys are experienced Bay Area real estate. As long as it's well priced and well presented, it's likely to go.
Yes. And I think, we would look at the property, of course, before we would go on the buying side of it. So if for some reason that was a very specific property that may not sell, then we may not recommend this particular product. But I think that's probably 1% of the property. So it's probably very few. And like you said, preparing the property, oftentimes we might spend anywhere from $20,000 to $50,000 preparing a property, but it usually comes back 3, 4, 5, 6 times.
Yeah.
It definitely comes back to you.
You guys never cease to amaze me how you go into a house and you see stuff that us normal people don't see, and you just lick a paint here and put an extra door there, and all of a sudden, every time I've sold a house and I've seen it staged, I'm like, why didn't I have them come over before?
Drives me a wand.
No, like, can't I live like that anyway? Oh my goodness. Well, this was a great conversation. Thank you guys for joining me. And if any of you out there have questions for Courtney and Connor, they are amazing agents, and their information's here in the presentation here. And we'd love to help you. We'd love to help just run the numbers. And sometimes we run numbers and it's a 2-year project. And we say, you know what, let's talk about it in 2 years' time. And Courtney and Connor can tell you, well, you could do this, this, and this to the house now to get it ready. Or, you know, we have people who come to us on a Monday and we're in contract by Tuesday. So it works both ways. But we're here to educate you and to help you. So please do reach out to us. We're more than welcome to work with you and help you run some numbers. So thank you for joining us, and we'll see you soon.
Thanks for having us, Nikki.
Thank you.